Famous sayings on Wall Street. If you have been paying attention to the financial market for a while, you will undoubtedly have come across some of the most famous sayings on Wall Street. But what do they mean and who said them? In this video, we will go through 10 of the most popular phrases and discuss their meanings. The first one is buy low, sell high. It is a common phrase used in the context of trading and investing. It refers to a strategy where an investor buys an asset at a low price and sells it at a higher price to make a profit. The concept is simple. If an investor can purchase an asset at a low price and the asset's price increases over time, then the investor can sell the asset for a higher price and make a profit. The key is to identify assets that are undervalued or oversold and have the potential to increase in price. This strategy can be applied to any asset class, including stocks, bonds, commodities, and real estate. However, it requires careful analysis of market trends, economic factors, and other variables that may affect the price of the asset in question. It is also important to note that this strategy requires patience, as it may take time for the asset's price to increase to a level where the investor can sell it at a profit. Bulls make money, bears make money, pigs get slaughtered. Both bullish and bearish investors can make money in the market, but those who are greedy and take excessive risks, that is the pigs, are likely to suffer losses and get slaughtered. In other words, while it is important to have a positive outlook and take calculated risks, it is also crucial to avoid being too aggressive or overconfident. This phrase is often used to warn against the dangers of chasing high returns or getting caught up in market hype. It emphasizes the importance of taking a disciplined approach to investing and avoiding the temptation to take unnecessary risks or make impulsive decisions based on emotions. Successful investors understand that investing involves both risks and rewards, and they carefully balance the two to achieve their financial goals. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. This phrase is often attributed to Benjamin Graham, the father of value investing. It means that in the short term, the stock market is driven by investor sentiment and emotions, and prices can be influenced by factors such as news events, rumors, and hype. In other words, the market behaves like a voting machine, where investors vote with their dollars based on their beliefs and perceptions. However, in the long run, the market is driven by the underlying fundamentals of the companies that make up the market. Over time, the market tends to reflect the true value of companies, and prices are more closely aligned with the company's financial performance, growth prospects, and other fundamental factors. This means that the market behaves like a weighing machine, where the true value of companies is eventually reflected in their stock prices. It is a reminder to focus on long-term fundamentals rather than short-term fluctuations in the market. It emphasizes the importance of conducting careful analysis and due diligence when making investment decisions and not being swayed by short-term market trends or investor sentiment. Be fearful when others are greedy, and be greedy when others are fearful. This well-known investing adage was popularized by Warren Buffett. When the market is bullish and investors are optimistic and eager to invest, it may be a sign that the market is overvalued. It may be wise to exercise caution and avoid getting caught up in the hype. Conversely, when the market is bearish and investors are fearful and pessimistic, it may be a sign that the market is undervalued, and it may be an opportunity to buy quality investments at a discount. The phrase suggests that successful investors should take a contrarian approach and go against the crowd. Rather than following the herd and making investment decisions based on emotions and hype, investors should remain disciplined and level-headed and base their decisions on careful analysis and evaluation of market conditions and investment opportunities. It is also a reminder that fear and greed are powerful emotions that can drive investment decisions, and that successful investors need to be aware of these emotions and learn to control them to make rational investment decisions. In bear markets, stocks return to their rightful owners. This phrase is believed to have been said by the financier and investment banker J.P. Morgan. During a market downturn, the value of stocks decreases, and those who are not long-term investors or speculators may sell their stocks out of fear or panic. This selling can cause the stock prices to decline further, eventually reaching a point where the more experienced and patient investors will start buying stocks at a discount. The phrase suggests that the stocks are returning to the investors who understand the fundamental value of the companies and are willing to hold on to their investments for the long term, rather than selling in response to short-term market fluctuations. Thus, it implies that market downturns provide opportunities for experienced investors to acquire stocks at discounted prices and eventually profit when the market recovers. Know what you own and know why you own it. This is a quote from Peter Lynch, the legendary investor who became the head of Fidelity's Magellan Fund in 1977. Lynch advises that you learn about the companies you invest in and understand the reasons why you chose to invest in them. Knowing what you own means researching the company's financials, management team, industry trends, and potential risks and opportunities. By following this principle, investors can make informed decisions about their investments and avoid making emotional or impulsive decisions based on short-term market movements. The trend is your friend. This is a popular adage in trading and investing. It emphasizes the importance of following market trends. It suggests that it is easier to profit by following the direction of the prevailing trend in the market rather than trying to fight against it. It implies that investors should be more inclined to buy stocks that are trending upward and sell those that are trending downward, rather than making decisions based on their personal beliefs or emotions. Following the trend can be particularly helpful in identifying entry and exit points for investments, as it can provide a clear indication of when to buy or sell an asset. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Articulated by George Soros, it means that successful investing is not only about making correct investment decisions, but also about managing risk and maximizing gains. Being right or wrong on an investment decision is not the only factor that determines success in investing. Instead, it's more important to focus on making a profit when you are right and limiting your losses when you are wrong. In other words, investors should aim to maximize their gains while minimizing their losses, regardless of whether they are ultimately proven right or wrong. Price is what you pay. Value is what you get. Here, Benjamin Graham refers to the difference between the price of an asset and its intrinsic value. The price of an asset is what an investor pays to acquire it, while the value of the asset is what the investor gets in return for that price. The price may be influenced by market forces, such as supply and demand or investor sentiment, and may not always reflect the true worth or value of the asset. On the other hand, the value of an asset is determined by its underlying fundamentals, such as its earnings potential, growth prospects, and competitive position. Investors who focus on the value of an asset are more likely to be successful in the long run, as they are investing in assets that are likely to generate significant returns over time. The phrase suggests that investors should not be solely focused on the price of an asset, but also on its underlying value. In other words, investors should seek to acquire assets that are undervalued by the market and have significant upside potential, rather than simply chasing assets that are popular or in demand at the moment. The time to buy is when there's blood in the streets. This is a famous quote attributed to Baron Rothschild, an 18th century British nobleman and banker. It means that when there is a market crash or a significant drop in asset prices, it may be an excellent opportunity to buy assets at a discount. The phrase suggests that when there is panic selling and widespread fear among investors, it may create an opportunity to purchase assets at a lower price than their intrinsic value. This strategy is often associated with value investing, where investors seek to buy undervalued assets that have been oversold by the market. However, It is essential to note that this quote does not mean that investors should rush into the market and buy any asset without conducting proper due diligence and analysis. It's crucial to understand the underlying reasons for the market crash or asset price drop and evaluate the long-term prospects of the asset before investing. There you have it. We hope that you've enjoyed this video, and if you feel we've earned it, consider subscribing to our channel. We'll be back with another video soon.